Good morning. I'm Eric Toder, co-director of the Urban-Brookings Tax Policy Center, and I want to welcome you all to the 10th Conference on Tax Compliance, co-hosted with the Internal Revenue's Office of Research, Applied Analytics and Statistics. I regret that we can't be together in person, but thanks to our technology, I'm very pleased to learn that we have a very large and diverse audience today, which includes many of my old friends and colleagues. There are a few housekeeping items I'd like to go over before beginning our program. First, today's virtual conference is being recorded and later will be made available online. Second, all participants joining us today are muted. Throughout the discussion, I encourage you to type your questions or comments into the question box at any time, and please include your name and any organizational affiliation that you might have. We have staff monitoring the questions coming in, and we'll do our best to answer as many questions as possible. We encourage you to follow the conversation online using the hashtag #LiveAtUrban. That's #LiveAtUrban. And all slides you see featured today are posted on our website. We have a great program today put together by the co-chairs, Alan Plumley of IRS and Rob McClellan of TPC, and the rest of the IRS program committee. We have sessions on audits, effects on taxpayer behavior, other determinants of compliance behavior, advances in taxpayer service, and how to improve IRS efficiency in the face of declining budgets, certainly a topical subject for these days. We also have a wide range of presenters and discussants coming from the IRS, other federal government agencies, academia, private consulting, and even from overseas. So I hope you will tune into as much of the program as you have time to. And this year, we're especially pleased to have former Commissioner Charles Rosati as our keynote speaker. Commissioner Rosati will speak at 12:30 this afternoon and will present his views on how to reduce the tax gap. Now I'm very pleased to introduce Barry Johnson, Acting Chief of Research Applied in Analytics and Statistics at IRS and Director of Statistics of Income at the IRS. We are very familiar with Barry and really appreciate all the work he has done for the tax community. And I'll turn it over to you, Barry.
Well, good morning and welcome to everyone, both to those of you who are conference veterans and to our newcomers. Thanks for taking time to be here today. What looks like a really outstanding program. Like Eric, I encourage you to fully participate and engage in today's presentations by sending us questions and comments and using social media to discuss the program. Following the instructions that Eric gave us, and the monitors will remind you of every once in a while, we really want this to be as interactive as possible. As we begin, I'd too like to thank Alan and Rob and the program committee for their work to put together the conference today. I'd like to particularly acknowledge Alan for his work organizing this conference. He's been doing this for a long time. He continues to inspire those of us at the IRS who are fortunate enough to work with him. He's dedicated to applying his deep technical skills to projects that improve the taxpayer experience and to our understanding of taxpayer behavior. And Alan, thank you for all that you do. I'd also like to thank the Tax Policy Center and Eric Toder for once again partnering with us on this conference and for enabling us to be fully virtual this year. As you noted, this is the 10th year that RAS has partnered with TPC to host this conference, which is the only regular conference in the US that focuses solely on tax administration. It's been really gratifying to see how over the last 10 years the quality of the work being presented has advanced. I'd like to send my thanks also to all the presenters for the willingness to take time to share their work with us today, and especially for embracing the fully virtual format of this year's conference. So much has changed since March, and we really appreciate the adaptability of our presenters who have already shown in working with the TPC to make sure that today's technology works as well as it possibly can. Before I step aside, I would like to also take a moment to acknowledge the extraordinary work that the IRS has been doing since the COVID-19 related evacuation orders were issued back in March. Since then, the IRS has issued about 160 million economic impact payments and is processing almost 10,000 requests for advance payments of employer credits due to COVID-19. My organization, Research, Applied Analytics and Statistics, or RAS for short, pivoted to 100% telework without really missing a beat. As you'll see reflected in today's presentations, we continue to partner with business units across the service and outside researchers to help modernize operations, improve taxpayer service, reduce the tax gap, and improve transparency. We've also provided critical support to the service's COVID-19 relief activities in a number of ways. These include producing burden estimates to support approval of new tax forms, helping to build models to detect fraudulent claims for EIPs, and developing comprehensive data sets to support downstream research and analytics of the research programs. As the service moves to reopen facilities, RAS is also working with the business units to revise work plans and reestablish workload priorities. The hard work and dedication of the IRS staff, and in particular of the RAS team in response to the pandemic, has been nothing short of amazing. And so I want to close by thanking them for all that they are doing. So now, without any further ado, it's my privilege to turn the program over to Rob McCullen to start our first session. Thank you, and please enjoy the day.
Thank you, Barry. So in our first session, we have 3 presentations. The first presentation by Brian Erard is the specific deterrence implications of increased reliance on correspondence audits. The second presentation by Lee Nickel is the specific indirect effect of correspondence audits moving from research to operational application. Our final presentation this morning by Matthias Kasper is the effect of audit risk and detection risk on tax compliance. Our discussant for this morning is Janet Holtzblatt. I'd like to say that each speaker will get 20 minutes and the discussant will have 15 minutes. And I'd like to remind everyone that these slides are available online, as Eric has already mentioned. So, Brian, you're up.
Okay, well, thank you very much for the introduction and for inviting me to talk today. I wish I could be with all of you in person, but virtual is the next best thing. So today I'm going to talk to you about the specific deterrence implications of increased reliance on correspondence audit. This is joint work with my colleagues Eric Kirkler and Jerome Olson. This was work that was done for TAS, and I want to thank Nina Olson for involving me and my merry band of Austrian psychologists and economists for a number of years doing some fascinating work. Although they're not listed as authors on this piece, Sebastian Beer and Matthias Kasper contributed to this work and no doubt will be involved in drafting a paper based on it. The usual disclaimer applies. The opinions I share today are my own, don't necessarily apply to TAS, to IRS more generally, or to anybody else for that matter. So I've got to take control of the screen, don't I? I clicked it. There we go. Thank you. So when we talk about audits, there's 2 types of deterrence effect that are usually talked about. One is general deterrence, and this is the idea that the general taxpayer population tends to be discouraged from cheating on their taxes due to the threat of audit and punishment. And then there's specific deterrence, which is what I want to focus on today, which has to do with the actual experience of an audit impacting one's future tax compliance behavior. I'm having some difficulty controlling the screen for some reason. I've tried to accept the control without much success here. Thank you for switching. We might have to go that way.
Yeah, hi Brian. If you just say next slide, I'm happy to advance for you.
That'd be great. Thank you. Okay, so back around 1990, I did a study looking at the specific deterrent effect of an audit. I had looked at taxpayers who had been subject to a risk-based audit in 1 year, and then just by bad luck got subjected to a random TCMP audit a couple of years later. Unfortunately, those results were inconclusive about the specific deterrent effect of an audit. And for the next, I don't know, 15 years, not much happened in terms of research on this issue. But in recent years, there's been a number of studies looking at this, this impact. Most of them have been based on random audits, either in a lab or a field setting. An exception is the work that was done by Lee and the RAS team, which we heard about last year, and we'll hear a little more about today. Many of these audits find evidence of a specific pro-deterrent effect that attenuates over time. So following the audit, people tend to become more compliant, but it eventually tapers off and they go back to their old ways. However, some studies have reported instances of a counter-deterrent effect. An example is work I did with Sebastian Beer, Matthias Kasper, and Eric Kirkler, where we found that people who were compliant according to the audit tended to become non-compliant following the audit. So that was interesting. These studies that exist in the literature don't distinguish between types of audits, and that's what I want to focus on today. So if we can switch to the next slide, please. So what's the motivation for this study? Well, the IRS has become much more heavily reliant on correspondence audits over the years. Back in 1990, IRS did more auditing overall, about 1% of all returns, compared to a little over 0.5% nowadays. But the other seismic shift has been it's gone from auditing about 62% by face-to-face to doing about 81% of its audits by correspondence. So a rather dramatic shift there. Next slide, please. Well, why should that matter? Well, compared to face-to-face exams, correspondence audits tend to have a much narrower scope. They only involve one or a few issues on a return. They're much more impersonal. They're less likely to be perceived as real audits. We know this because we conducted a TAS survey where we found out that taxpayers didn't tend to think of correspondence audits as audits at all. If you asked them if they'd been audited in the past, they said no. They're also much less likely to receive a response from the taxpayer. Now, I haven't looked up the statistics, so don't quote me, but I think it could be as much as, you know, half of people who receive an audit by mail don't respond. And so there's a real response issue with this type of audit. And if we can go to the next slide. What's the implication of these differences? Well, correspondence audits and face-to-face audits, since they're different in their nature, might very well have different implications for the perceptions the taxpayers take away from the audit. They might have different views about future audit risk, about the capacity of the tax administration to uncover evasion when it's present, about the level of certainty about their true tax liability. All of these things might influence future reporting behavior. In addition, depending on whether they have a positive or a negative experience coming out of the audit, it might impact their tax morale, that is, their intrinsic willingness to comply in the absence of any threat of punishment. If it's a bad experience, it may crowd out that tax morale and make them less compliant. On the other hand, if it's a good experience, it might crowd in the morale. And we'll move to the next slide. So how did we study this? Well, we got some great data. We have very large samples of self-employed taxpayers, and I'm going to focus on 2 years, tax years 2010 and 2014. For both years, we have samples of taxpayers who were subjected to face-to-face and correspondence audits. And we also have a sample that we use for comparison purposes of unaudited taxpayers. To make this a legitimate study of audit effects, we put some exclusion restrictions on both samples, such as making sure the people had filed before and after the audit, making sure that the non-audit group hadn't been audited for the past several years, and things of that sort. And so now we can move to the next slide. So how does one use that data to estimate the impact of audits on future reporting behavior? Well, For the folks who were audited, we observed their post-audit change in reported tax. And so we know what happens after they get audited. The thing that we don't know is if they had not been audited, how much would they have reported in that case? And so we have to estimate this counterfactual. What would they have reported had they not been subjected to an audit? And we'll go to the next slide. So estimating the counterfactual, we're going to talk about a method called inverse probability of treatment weighting to try to accomplish this. The basic idea is that we're going to use our comparison group of unaudited taxpayers to give us an idea about the counterfactual. And what we're going to do is, instead of just taking an unweighted average of these folks, we're going to take a weighted average. And this is because we're not using random audits, but risk-based audits. And so we need to make the characteristics of the unaudited taxpayers more similar to those of the audited taxpayers. And the way we do that is we apply weights to the taxpayers in the non-audit sample. And intuitively, we put more weight on unaudited taxpayers who had a high relative likelihood of receiving the relevant type of audit, either correspondence or face-to-face. And the next slide. So how does this counterfactual weighting work? Well, we estimate what's called a multinomial logit analysis, which generates estimates of the probabilities of a correspondence, a face-to-face, or no audit at all. And we use these weights to construct our, these probabilities to construct our weights. So for example, in the case of the correspondence audit, we're going to take an average over the folks who weren't audited, but we're going to weight it by the relative probability of receiving a correspondence audit to receiving no audit at all. So for example, if one person had a 2-to-1 chance of receiving a correspondence audit in the sample, and another person only had a 1-to-2 chance, the first person would get a weight 4 times larger than the second person, because that person was much more likely to have actually received a correspondence audit, and therefore much more likely to have been in the sample that we observed of correspondence audit cases. Similarly, for the face-to-face audit counterfactual, we'll take a weighted average using the relative probability of a face-to-face audit to no audit at all. And the next slide. So what's our strategy? Well, we're going to apply this to estimate the specific deterrent effects over the next 2 years following the audit. Now, some audits didn't start until after the taxpayer had already filed the next year's tax return. So in these cases, the person couldn't have had an audit impact on that next year's return because the audit hadn't started yet. They didn't know about it. So we're going to use this 1-year effect as a placebo test. We're hoping that if our approach works well, that we'll end up with small estimates of the deterrent effect in that placebo year, and that ideally they'll be statistically insignificant. So let's see how that turned out for that group. Next slide, please. Well, what we see in 2010 is in the placebo year, the estimates are indeed small and statistically insignificant. Whereas for the first year following knowing about the audit, in this case 2012, there's a very large coefficient estimates that are statistically significant. So that's suggesting a pro-deterrent effect. How about in tax year 2014? Well, here we again get relatively small estimates of the placebo impact, but in the correspondence case, it was statistically significant, which is a bit of a concern. But if you look at the estimate of the size of the coefficient compared to the first year impact, it's very small. And so we're still fairly confident that we're estimating a real effect with our model. These are a little bit hard to interpret, right? We got the change in the natural log of reported tax. The reason we're looking at the change in reporting behavior post-audit is we wanted to difference out individual specific effects, what we call individual fixed effects. The reason we use the natural log of reported tax is because tax data tends to be very skewed and we wanted to smooth out the distribution. However, this is a little hard to interpret. What's the change in the log of reported tax? So in the next slide here, we look at the percent change in reported tax. We've converted it for you. And what are we finding for the first year after they knew about the audit? Well, for both face-to-face and correspondence audits, we estimate a very large specific deterrent effect. As a result of the audit in 2010, taxpayers reported 37% more tax in 2012. In 2014, the effect of the audit was even more dramatic. So that's quite interesting. So these are folks who got audited only after filing the next year's tax return. And this is looking at their behavior in the year following that. Let's look now at the other group who got audited shortly after they filed their returns. Next slide, please. Here things are kind of interesting, right? For both years, if you received a correspondence audit, you actually reported less following the audit. So 1 year ahead and 2 year ahead, you reported less than you did before the audit experience. So there's a counter-deterrent effect that we're finding. In the face-to-face case, it's much like the other group. We're finding a positive pro-deterrent effect and a very substantial one, both 1 year and 2 years out. So if we can go to the next slide, the question then becomes, what's going on with correspondence audits? The results seem to show a counter-deterrent effect for folks who get audited shortly after they file their returns, but a pro-deterrent effect for folks who get audited later on in the cycle. Well, one explanation we investigated is, are these types of issues or taxpayers that are different for the earlier and the later audits? And maybe that's what's driving it, is that we're looking at different groups of taxpayers or different types of tax issues. Well, what we found is that earned income credits, which account for a very large portion of all correspondence audits, tend to happen early in the audit cycle. And so these are, there's a lot of these folks that get audited before they file their next tax return. So what we did is we separated out our analysis for whether there was an EITC issue involved or not in the audit. And we estimated our model separately on the two groups. Surprisingly, this was not the explanation. It turns out whether you had an EITC issue or not, if you got audited early in the cycle, there was a counter-deterrent effect. And if you got audited late in the cycle, there was a pro-deterrent effect. So that raises a question, maybe it's actually the lapse in time between filing and getting audited itself that matters. And indeed, Jeremy Bentham had a theory about this. He talked about celerity, or the swiftness of an audit, or swiftness of a deterrence experience. And he argued that swift correction and punishment had a much stronger pro-deterrent effect than if that was delayed. However, here we're finding just the opposite. We're finding that those who get audited shortly after filing actually become less compliant, while those who were audited later become more compliant. So that's quite interesting. Don't have an explanation at this point. So what's the next slide got to say? Well, how do we know our results are right? Well, we don't, but we did try to validate them. So one thing we did is we tried two other estimation techniques. One was inverse probability of treatment weighting combined with a regression adjustment. This is called a doubly robust estimator. If we get either the probabilities of audit right, or we get the modeling of the non-compliance change correct, this model tells us that we should get consistent estimates of the specific deterrent effect. We also developed a new methodology involving statistical matching on the full vector of propensity scores. So we match not only on your probability of getting, say, a correspondence audit, but also your probability of getting a face-to-face audit or no audit at all. And we developed and applied that methodology. Both of these alternative techniques gave us qualitatively very similar results, which was encouraging. The other thing we did is we estimated the intermediate years, 2011, 2012, and 2013 audits, and we got very similar results for those years as well. So that's encouraging with regard to our findings. So if we can move to the conclusion slide. This is one of only a few studies that focus on operational audits, risk-based audits, as opposed to random audits. That's important because those are the types of folks that are actually targeted by audit activity, and it's their behavior that we're most interested in when we're looking at specific deterrent effects. It's also, I believe, the first study to distinguish between audit types when looking at specific deterrents. And that's important because there's no reason to expect that face-to-face and correspondence audits are going to have the same impact. We know that correspondence audits aren't a perfect substitute for face-to-face audits. They're more narrowly targeted, they're more impersonal, And we now know they're less consistent with regard to specific deterrent impact. More research is needed to understand why. Further research, I might note, is also needed to understand whether IRS has struck the right balance between face-to-face and correspondence audits. As I pointed out, there's been a seismic shift in its strategy, moving towards correspondence audits and away from face-to-face audits. Part of the result of this is an awful lot of folks are getting audited for refundable credits relative to other reasons nowadays, and they tend to be concentrated geographically in the Deep South. It's not entirely obvious that this is the right balance, and I do think more research is needed in that area. So now I'm going to conclude, and I'm going to turn things over to Lee for a very interesting presentation.
Okay, thank you, Brian. I think I'm just waiting for mouse control or to see my slides. Okay, great. So I will be presenting today on the specific indirect effect of correspondence audits. As Brian mentioned, this is the second year of this research effort, and the first year was presented at this same conference last year by my co-author, Lucia Leike. However, this year, our focus has been on translating our research to operational applications. And before I get started, I'd like to thank my co-authors, Max McGill and Lucia Leike from the MITRE Corporation, as well as Alan Plumley from the IRS. Okay, so Brian already covered this, but as a quick recap, there are two known documented types of indirect effects in the tax enforcement literature, the specific and the general. The specific, again, being when an enforcement activity changes the future reporting behavior for that same taxpayer, and the general indirect effect, sometimes called the spillover or network effect, being when an enforcement activity modifies the compliance for other taxpayers around the audited taxpayer. For example, geographically connected or sharing the same employer or something to that effect. Like Brian, I will also be focusing on the specific today, although MITRE also has a parallel research effort looking at the general indirect effect of taxpayer networks. We have two research questions. The first is, can we compare audited taxpayers to similar not audited taxpayers and identify any evidence for an indirect effect, in our case in correspondence audits? But the second question is, how could we use those results to actually improve IRS audit operations? And this would be done ideally by generating estimates that are on the dollar scale, such that they could be used to compare different types of audit categories and be helpful in determining what resources should be allocated where. So to speak a little more to that second research objective, we know that different types of audits, even different types of correspondence audits, vary in terms of their direct revenue or the direct effect, where the direct revenue is the tax adjustment assessed by the exam. And we expect that different types of correspondence audits may also differ in terms of their indirect revenue. To be able to use indirect revenue to allocate IRS resources would mean identifying types of audits that have the best quote unquote bang for the buck in terms of their total revenue, where total revenue would be the sum of the direct and the indirect revenue. Now, subsequent compliance cannot be explicitly observed in the absence of repeated audits. And so we use estimated differences in total tax between our audited and not audited groups as our proxy for indirect revenue in this study. We examined 5 categories of correspondence audits, which again are audits conducted via mail. Our first 3 categories are common to our presentation last year, but we've added in some new categories as well. Audit category 1 examines some Schedule C business expenses. Audit category 2 looks at some Schedule A deductions. Audit category 3 considers Schedule SE items for self-employment. Category 4 looks at education credits, and category 5 examines some Schedule E passive activity loss items. Important to note is that we are using operational data in which audits are not assigned at random. And I will be speaking more to how that plays into our analysis and how we mitigate selection bias in the coming slides. To start, I'd like to briefly go over how correspondence audits are selected, because I think it's very helpful then to understand how we designed our study. If you consider the entire taxpayer population, here represented by that large blue circle, the first step in identifying taxpayers for a correspondence audit is to apply a filter, here represented by the dashed line. The filter selects a candidate pool of returns who meet some initial criteria for that audit. And within that pool of candidate returns, not all returns are necessarily created equal. In other words, they may have different audit potentials. And here that is represented by those varying sizes of the red circles, which are denoted with the priority or prioritization metric. The priority is the best surrogate for the tax change, and that is calculated in step 2. After the priority has been calculated for all candidate returns, those candidate returns are ranked by priority and typically worked in a top-down fashion. What's important to note is that the filter and priority are unique for each category of audit. And so our 5 audit categories considered all have different filters and different priorities. Now I'm going to talk about our analytical sample. We draw primary taxpayer information from the IRS's compliance data warehouse. And a phrase that I'll be using throughout the presentation is the baseline year. This is the tax year that the taxpayer entered the sample, either due to being audited in that tax year or due to being eligible but not audited in that tax year, excuse me. So our treatment or audited group consists of all taxpayers audited for a given audit category in tax years 2006 through 2012. Our control group is a random sample of taxpayers who are not audited but met the business rule filters in the last slide. They were selected into that rectangle in the last slide for the same audit categories in the same tax years. We pull 1040 and schedule information for up to 8 years after the baseline year, up to tax year 18, and we thought this would be sufficient to be able to detect any sort of indirect effect. So how big is our different audit categories? In this plot on the y-axis, we have the number of taxpayers in thousands, and on the x-axis, we have the baseline tax year. You can see that there's variation in the sample size both within a given audit category over time and between different audit categories. For example, in audit category 1, 2010 was a high volume audit year and 2011 was a lower volume year. Both categories 1 and 2 have a sample size of roughly 250,000 taxpayers total over those 7 years. Category 3 is a bit smaller. Category 4 did not start until tax year 2008. And category 5 is our smallest category with approximately 11,000 unique taxpayers. We fit a linear mixed effects model for each of our 5 audit categories. And again, our dependent variable is total tax. We add $1 to all observations to mitigate the small proportion of returns that remit $0 in total tax. And like Brian, we do a log transform to account for the heavily skewed nature of our dependent variable. We include a random intercept for taxpayer, and also important to note is that both our dependent and independent variables that are on the dollar scale are adjusted to inflation to 2018 US dollars prior to fitting the model. We're interested in testing the null hypothesis that the tax reporting trajectories for our audited and not audited groups over time are parallel. And this is assessed via the interaction term between audit status, what group you're in, and the time that has passed since that baseline tax year. And you'll notice that we fit year as a categorical or factor variable, and this is meant to allow it to have a nonlinear slope over time. We have been working hard over the last year to account for additional potential confounders between audit status and tax. You'll see that we're controlling for priority at baseline, which again was the red circle several slides ago. And we're also adjusting for a handful of other taxpayer characteristics, such as filing status. We're also adjusting for tax year, which we mean to include to capture potential economic or policy changes over our study period. And I'd also like to point your attention to the bottom right of that table, in which we're controlling for total tax in year -1, meaning in the year before baseline. And this allows us to interpret our estimates as for two taxpayers with similar filing, who have the same priority at baseline and who have the same tax reporting the year before. Here's what we see. Now, before we look at any results, it's important to understand the audit timing for our 5 categories. Unlike the last presentation, we do not have any pre-refund categories that we considered. The 5 categories we considered all begin roughly 2 to 3 years after that baseline year, after filing, here denoted by the yellow density plot. Most audits close by year 5, with the majority closed by year 4. And this is all important because we would not expect to see any sort of behavioral changes before year 2 or year 1, really. There's a small proportion of taxpayers who are notified between years 1 and 2, but we really expect to see any behavioral changes in that year 2 to 4 range. Okay, so now I'm going to present the results for our 5 total tax models. Because of the log transform, our estimates are on the multiplicative or percent scale. So the y-axis on these plots is the percent change in total tax. And the x-axis is the years that have passed since baseline. The red line represents the audited estimate, and the blue line represents the control estimate. The shading represents 95% confidence intervals. So what you'll see is that the audited group appears to, on average, increase their total tax reporting in years 2 to 3 for the first 4 audit categories. This is seen more starkly in categories 1 and 2, and a bit more weakly, however significant, in categories 3 and 4. There's insufficient evidence to suggest any sort of interaction effect for category 5. One other thing I'd like to point out on this slide is that you may notice that our intercepts for the 2 groups at year 0 are not always right on top of each other. And I'd like to highlight that, once again, we're more interested in the slopes of these 2 groups over time and whether or not they're parallel, rather than their starting values for total tax. And we believe that it makes sense that taxpayers who have similar characteristics, except for their tax reporting, might represent the delineation of exam selection. So we have our results on the percent scale, and now we'd like to make them more useful. As mentioned, the direct effect, the tax adjustment following an exam is in dollars, and so we translate our percents to dollars such that they can be combined with the direct effect. We choose to do this at the aggregate level, meaning we estimate an average indirect effect for an entire category of correspondence audit, rather than doing this at the micro level or taxpayer level. And we do this because the aggregate level we feel is more helpful in terms of allocating resources to different types of audit categories. Whereas the micro level, while it could be helpful to inform exam selection, potentially, it would require a slightly different data set and modeling approach that was out of scope for us at this time. So I'm going to speak very briefly about how we make that translation from percents to dollars. We start by looking at the interaction estimates. So here presented for category 1. And these interaction estimates are transformed and multiplied with estimates of the average total tax reporting by the audited group in each of the 8 years. That gives us an estimated dollar effect attributable to being audited and attributable to that year since baseline. We get those dollar estimates for all 8 years, but we choose to sum them only for the first 5 based on our modeling results and based on prior literature that also noted an attenuation and indirect effect after year 5. Okay, So before looking at those indirect revenue estimates, let's look at the direct revenue for these 5 audit categories. Here we have the average direct effect, which has been adjusted to 2018 US dollars. And you can see that the green bar representing audit category 5, which was again for passive activity loss, has the highest mean direct revenue on the order of $4,500. Categories 1 and 2 are quite similar in their mean direct effects, more on the order of $2,500. And categories 3 and 4 have a bit smaller mean direct effects on the order of about $1,300 or $1,000 respectively. Next, we add in those dollar estimates of the indirect effect from summing our dollar effects from years 1 through 5, here represented by the lighter shading on the bar plot. And we see a complete reordering of our 5 audit categories. Category 5, because there is insufficient evidence of an interaction, gets $0 for their indirect revenue. Categories 1 and 2 both had an estimated indirect revenue on the order of about $4,000. And categories 3 and 4 had smaller estimates of indirect effect on the order of about $700. And what you'll notice is that the audit categories 1 and 2, their indirect revenue was almost twice that of their direct revenue. And this might imply that the larger the direct revenue, the larger the indirect revenue, if we look at this plot, which we think makes some intuitive sense in that the larger the slap on the wrist, so to say, the larger the induced behavioral response might be on average. So in summary, we have identified evidence of an indirect effect on total tax reporting for 4 of our 5 audit categories considered. We see differences in the magnitudes of those effects, meaning that we don't think that all categories of correspondence audit are created equal. While audit category 5 had the largest mean direct effect, when considering the total revenue, the sum of the direct and estimated indirect revenue, it appears that audit category 1 has the largest total revenue. While audit category 2 also had significant or substantively large total revenue, if you recall, that was looking at the Schedule A, and we are aware that the Tax Cuts and Jobs Act increased the standard deduction limit and would result in less taxpayers who itemize. So the landscape of Schedule A filers has changed since we began this study, and we acknowledge that our results for that category may not generalize well to that category in the future. Now you may be wondering, does the audit outcome affect the indirect effect? And this was something that we explored as well. So we could disaggregate the audited group into those with a change, those that had a tax adjustment greater than 0, and those without a change that had $0 in tax adjustment. Here we can see represented by the green line for the change group that they appear to, on average, increase their total tax reporting a bit more than their no change counterparts. And while this is interesting from a behavioral and research perspective, we believe that the 2 group models are more useful for resource allocation, and to be able to use the 3 group models to make resource decisions would require a priori knowledge of the change rate of an audit category, and predicting the change or no change rate of unaudited returns was out of the scope for our current project, but there would be some potential there to consider pursuing this. And one last thing I'd like to point out on this slide is that our control group is the same as the 2 group models, and it's likely that that control group is made up of, one would hope, many no change returns if they were to be audited. And so that control group might not be the best comparable group for the change audits. And so there would need to be some tweaking in order to be able to use these 3 group models. So in addition to the filters and priorities, we acknowledge that there's still some underlying differences in the characteristics of the audited and not audited populations, and we hope to continue to mitigate selection bias with some additional methodologies tested in the next couple months. We also acknowledge that the filter and priority we have access to now may not have been constant throughout our entire study period. And if those filter rules have changed over time, then that could impact the validity of our control groups. And on an exciting note, last year we launched an experiment with Campus Exam for one audit category in which we withheld a portion of returns that would have been audited and withheld them from audit. And we look forward to seeing those results in a couple of years. So that concludes my presentation. Thank you for your time, and feel free to reach out to me or my co-authors with any questions. And next, I will hand it over to Matthias Kasper.
Thank you very much, Lee. I cannot see myself. I hope my camera is on, and I also hope my mic is working. That should be working at least. Thank you for the handover, Lee, and also thank you very much to Alan and the organizers for having me today. My name is Matthias Kasper, and this is joint work with Jim Alm, formerly now of Tulane University. And just like, okay, great. And just like the two presentations we've been learning about this morning, we were interested in better understanding how experiencing an audit affects post-audit, so subsequent tax compliance. And in contrast to those studies, our focus in this presentation is a little bit more on the behavioral drivers of those responses. So we were interested in learning more about why it is that some taxpayers seem to increase their reporting while some seem to decrease their reporting in the period following an audit. Somehow I'm unable, no, oh, oops, wrong direction. Okay, here we go. Now the literature on deterrence typically distinguishes between threatening punishment and experiencing punishment. And the vast majority of research, in particular on tax compliance, focuses on the prior. So we know very well today that taxpayers respond to the threat of enforcement. We know that, for instance, threatening close inspection increases compliance absent any audits. And we also know that changes in the underlying tax system parameters, so increasing the probability of audit and also increasing the fines for non-compliance, have a positive effect on taxpayer reporting. There is, however, also the observation that compliance levels tend to be higher than theory predicts. So most taxpayers face a relatively modest risk of an audit, and assuming that they're motivated by financial incentives alone, taxpayers on average should cheat somewhat more than much empirical evidence suggests. And there have been various explanations for that finding. One is obvious, I didn't list it in the slides here, that third-party reporting accounts for a big share of that, of these high compliance levels. But there also seem to be some behavioral dynamics involved. For once, there's a lot of evidence that taxpayers overestimate the risk of an audit, and theories have been developed to reflect that, and thus to project compliance rates that are more in line with the actually observed compliance rates. However, as Brian mentioned in his talk already, taxpayers also seem to differ in their motivations to comply. So some taxpayers are just inherently honest, and those taxpayers will likely report all income correctly, even absent any enforcement. The literature on the effect of audits on subsequent compliance is somewhat more recent. So today there's a good bit of evidence showing that experiencing an audit increases post-audit tax compliance, and there's great work from the US, the UK, and also Denmark that finds that the revenue effect of auditing taxpayers is positive. However, as we've learned already today, there's also an emerging literature that seems to suggest, or that suggests, that behavioral responses to audits are more ambiguous. And in particular, some studies suggest that whether or not a taxpayer increases his subsequent tax compliance after an audit depends on whether or not the audit found him or her to be compliant or not. So in our work, for instance, that Brian made reference to before, we found that taxpayers who were audited and received an additional tax assessment, so who were apparently non-compliant, report more income and substantially more income in subsequent years, while as those taxpayers who did not receive an additional assessment, where the IRS could not find any indication for underreporting, reduce their compliance in subsequent years. And there's several potential explanations for such a behavior. The traditional perspective on this would be that the audit provides the taxpayer with new information. So if, for instance, the taxpayer learns that the auditor is better or worse at detecting non-compliance than expected, then this should be reflected in his future behavior. So if unexpectedly the audit has not been able to detect cheating, for instance, a taxpayer might report less income on his subsequent returns. Conversely, if the auditor has been better at detecting non-compliance than expected, the taxpayer would increase his subsequent compliance. Now, in addition to this explanation, there's also a lot of work in the behavioral realm, where various studies provide strong evidence for differential responses to audits that do not necessarily align with that explanation. So, for instance, there's relatively strong evidence from lab studies in which taxpayers generally, and in most of those studies, that's important, they've been randomly selected for an audit, so not based on their prior reporting behavior. So in these cases, taxpayers often reduce their income after experiencing an audit. And the one explanation for this is that they believe that the risk of a future audit is low. So there might be some misperception in the change of audit risk after experiencing an audit. Other scholars have suggested that the audit experience affects taxpayers' willingness to take risk. So suppose that a taxpayer has been audited and found cheating, so that he had to or she had to pay a fine. It might be that if this experience affects that taxpayer's willingness to cheat more in the future in order to make up for this loss that he or she experienced as a response, as an outcome of that audit. As Brian mentioned already, it could also be that audits have a negative effect on those taxpayers who are intrinsically motivated to pay and who, even absent any enforcement, comply because they think it's the right thing to do. So those taxpayers might perceive that the audit signals distrust of the tax authority, or they might find it unfair to be selected for audit because they have been compliant in the past. And as a result, those taxpayers might be more inclined to cheat on their tax return. It is important to note that a lot of evidence, particularly experimental evidence, suggests that changes in behavior do not necessarily reflect changes in the underlying parameters. So that means that the experience of an audit can increase or decrease subsequent or post-audit compliance, even when the probability of an audit is unaffected by the audit outcome, for instance. And one behavioral explanation that we think provides a good and holistic perspective on the prior work of behavioral responses to audits is that taxpayers might base their assessment of the risk of a future audit on their ease of recalling their recent audit experience. So that would imply that what matters to a taxpayer in deciding whether or not he should comply more or less after experiencing an audit is how efficient this audit was. So whether or not the auditor was good at detecting non-compliance, and also what the outcome of the audit was. So was the taxpayer found to be compliant, in which case he did not face any penalties, so one would probably not assume that he would increase his subsequent compliance, even when the audit was inefficient and might not have detected all underreporting. Or was the taxpayer found to be non-compliant, in which case he was obviously punished and had a financial incentive maybe to report more income in subsequent periods. So in this study, we try to disentangle those different explanations for the observed decline in reported income after an audit among some taxpayers. And in particular, we were interested in studying how the efficiency of the audit, so whether or not the audit was able to detect all undeclared income affects subsequent compliance. And we also looked into how different types of taxpayers are affected by the audit experience. So were those who reported all income to the agency in the round that was audited respond differently from those who did not report any income. And likewise, we also look into the behavior of what we label honest taxpayers, who always report all income correctly in the absence of any enforcement, so until they're audited for the first time. And does the audit have a different effect on those taxpayers as compared to those who are rational in our case, in our study, and never report any income because the given set of parameters they were facing suggests that this would be the ideal strategy to maximize your after-tax income. Now, this is the only lab experiment that we're going to discuss today, I think. And you might ask yourself why, what the value added of such an approach is. Well, in this case, I think there are strong arguments to investigate this issue in a laboratory setting, because in reality, we can obviously very hardly just introduce variation in the efficiency of audit. So the audit outcome reflects the auditor's best guess of the taxpayer's true compliance, but it's not clear to what extent this reflects his actual compliance. So we do not really know in reality whether or not the audit has really detected all cheating that was present, and we also do not know as a consequence whether or not the taxpayer that has been audited has truly been compliant or not. And the lab experiment, obviously, in which we control for all these factors, allows us to dig into that. And very quickly, because you might not be extremely familiar with that methodology, even though there's a very large literature on the compliance implications of tax audits and changes to tax system characteristics in an experimental setting. These games typically mimic the standard voluntary reporting decision. So participants receive income, they face a set of tax system parameters, in our case, various levels of audit probabilities and various levels of audit efficiencies, and I'll provide more detail on this on the next slide. They faced a fixed tax rate of 25%, and they faced a constant fine for non-compliance equaling twice the evaded amount. So this is pretty much standard, except for the fact that one of our major innovations here is that we introduced variation in the audit efficiency to see how this affects pre and post-audit tax compliance. Our sample is relatively large for a lab experiment, so we have over 300 participants and close to 10,000 observations, so a reasonably large number of observations for studying these questions. A very quick glimpse at the experimental parameters. So participants played this game over 28 rounds, and as you can see, they face different levels of detection risk. And it's important to note that we calibrated our experimental parameters such that identical levels of detection risk would result from different combinations of audit probability labeled P and audit efficiency E. So for instance, in this case here, the audit would detect all undeclared income. The audit probability would be 18%, resulting in a detection risk of 18%. Whereas in other cases, such as here, the audit probability would be much higher, 60%. The audit efficiency would be much lower, only 30%. However, the overall detection risk would remain constant. So this allows us to not only investigate how differences in the composition of the detection risk affect pre-audit compliance levels, and there's behavioral literature on the misperception of probabilities, which I'm not going to go into here, but it also allows us to investigate the effect of variation in audit efficiency on post-audit tax compliance. Now, very quickly, some descriptive statistics. We find, and this is in line with much experimental work on tax compliance, a very bimodal compliance distribution. So many participants are entirely rational and respond to the design of the decision they're facing, the parameters they're facing, and those individuals never report any income throughout the entire game. On the other hand, there's a relatively large group of participants who always report all income they receive, irrespective of the enforcement parameters they're facing. So this provides some indication that there seem indeed to be different types of taxpayers who either aim to increase or maximize their after-tax income, while others just do what they believe to be the right thing. And there's obviously also some taxpayers who adjust their reporting according to the changes in risk that they're facing throughout the experiment. It's also worth to note that female participants are significantly more compliant in our study than male participants. This is again in line with much prior work. Now this slide again looks at pre-audit compliance levels, and as expected, we find that increasing the detection risk here increases compliance, so nothing unexpected. To the contrary, as one would assume, the more likely taxpayers are to be found cheating, the more income they report. So this is the relative share of declared income here. Why do we have bars in different colors? On the left-hand side, remember that we had some decisions in which the same detection risk comprises of different underlying audit probabilities and detection probabilities. Audit probabilities and audit efficiency. So the dark bars here, for instance, represent decisions where the audit was perfectly efficient and detected all undeclared income. And this provides you an idea already that taxpayers respond to the overall detection risk, but they do not respond to the composition of that detection risk. So we find no evidence for the hypothesis that taxpayers systematically over or underestimate audit probabilities relative to audit efficiencies. In fact, we would be surprised if we found differences, because we programmed our experiments such that participants had a little calculator on their screen, which would tell them how their reported income would translate into after-tax income, whether or not they were audited. So if they based their decision purely on the information provided by the after-tax calculator, one would not assume that differences in the composition of detection risk would have a strong effect on the reporting behavior. However, there's some prior evidence suggesting that this such a compound nature of the compliance choice, where the audit efficiency is distinct from the audit probability, might have some effect on reporting behavior. We do not find any evidence for this. I'll spend some time on this slide because I think it gives a nice intuition of our regression results, which I'm briefly going to walk you through in the coming slides. Now, this looks at the effect of audits on post-audit compliance. Taxpayers were audited in round 0, and we tracked their behavior over time without experiencing any additional audits. And in this graph, we distinguish between different types of taxpayers. So non-compliant taxpayers who do not report any income in the round that is audited, and partly compliant taxpayers who report some fraction of their income, but not all, and compliant taxpayers, those individuals who report all income correctly in the round that is audited. And you can see at first glance that there's strong differences in behavioral responses to audit. Starting with non-compliant individuals, we find that the audit, whether efficient or not, so the solid line is the average effect, the aggregate effect. The dashed line is the effect of inefficient audit, and the dotted line is the effect of an efficient audit. All different audit types, all different levels of audit efficiency induce a significant increase in post-audit tax compliance. So those taxpayers who did not report any income when they were audited report substantially more after experiencing the audit. Among those who reported some fraction of their income and evaded some fraction of their income, not much changes after experiencing the audit. This again would be the theoretical prediction if one assumes that all the information is available to the taxpayer. He knows that the audit outcome does not have any effect on his future risk of audit. So being audited is just a case of losing the lottery and should not result in a change in subsequent compliance. However, among this group of partly compliant taxpayers, there seem to be some behavioral dynamics. So while inefficient audits seem to slightly reduce post-audit compliance, we see quite solid increase in post-audit compliance among those who experienced an efficient audit. So among those taxpayers, it seems that the audit efficiency determines whether or not a taxpayer increases or decreases this post-audit compliance. Finally, the group of taxpayers who reported all income correctly in that round respond to an audit by substantially reducing their post-audit compliance, and this change is quite sustainable, as you can see here. Now, I brought two regression tables very quickly, but they basically corroborate what I've explained before. So overall, and we look only at first differences here. We also run a series of robustness checks, and we're also looking at changes not only in the first period after the audit, but also subsequent periods. But I think the most important takeaway message here can be deducted from this graph, this regression table. So we find consistently that increasing the risk of detection has a positive effect on compliance. We find that post-audit compliance depends on what we account for. So in the aggregate, looking at specification 1 here, audits do not have an effect of post-audit tax compliance. However, looking at specification 2, when allowing for variation in audit efficiency, we find that an inefficient audit reduces post-audit compliance by 3.6 percentage points, while a perfectly efficient audit, all else equal, increases post-audit compliance by 3.4%. So whether or not taxpayers increase their subsequent compliance depends on whether or not the audit detected all undeclared income or not. In the next two models, we also look at the behavior of compliant taxpayers, those who reported all income correctly in the round that was audited, and non-compliant taxpayers. When looking at compliant taxpayers here in model 3, we find that those taxpayers reduce their subsequent compliance quite substantially by 23 percentage points roughly in the round after an audit, while those who did not report any income in the round that was audited increased their compliance by roughly 18% one period after the audit. We also briefly mentioned the hypothesis that some taxpayers are inherently honest and that those taxpayers might respond to an audit by reducing their subsequent compliance. To investigate this, we looked at the impact of the first audit. So we distinguished taxpayers based on their reporting behavior prior to experiencing their first audit. Honest taxpayers always reported all income in all rounds prior to the first audit, while dishonest individuals never reported any income prior to experiencing an audit. And we find no evidence that audits crowd out the intrinsic motivation to comply among honest taxpayers. However, we do find that audits have a positive effect on post-audit compliance of dishonest individuals. So even though they should stick to their strategy of not reporting any income, if they were merely only interested in maximizing their after-tax income, experiencing an audit leads to an increase in post-audit tax compliance. I think I don't really need that summary slide because I might be running out of time already. I hope I made my takeaway points clear here. We find differential effects of audits. We find that the impact of audits on post-audit compliance depend on the audit efficiency, whether or not the audit was effective. And we also find that it depends on whether or not the taxpayer was compliant or non-compliant in the round that was audited, in line with, for instance, Brian, our earlier work, let's say, on the effect of operational tax audits on US taxpayers. What does that mean? I can't move on anymore. So maybe, okay, very quickly, what does that mean? So one implication I'm going to focus on today is that it might make sense for the IRS to avoid the perception that being audited and found to be compliant results in being off the radar for taxpayers. So even though there might not be enough resources to audit taxpayers for 2 subsequent periods when they were found to be compliant in the first audit, one strategy might be to send a letter to those taxpayers, similar to some field experiments that have been conducted in the past, just reminding them that they're on the hook and that the IRS is looking into their return. So with that, I'm going to close. Thank you very much. I'm now going to hand over to Janet, who is going to discuss all 3 papers, and then we'll have some time for Q&A. Thank you.
Hi, Janet. It looks like you are still muted.
Okay.
Yes, now we can hear you. Thank you.
Okay. This is not the first of technology problems I've had today. Let's hope we get through this okay. So I want to thank the presenters for 3 excellent and thought-provoking papers. I also want to commend the organizers of this session, because these papers are really well fitted together, and that makes my job as a discussant that much easier. Each of them considers different factors that affect the long-term or the indirect specific effects of audits on compliance. With Brian, it's the case of field versus correspondence in terms of those long-term effects. Lee is when you think about correspondence audits, which target issues are most effective. And Matthias says, what is it about the audits that make them most effective? And the takeaways are field wins over correspondence. As far as issues are concerned, deductions win over credits and self-employment. And for Matthias, it's not just the audit, it's the quality of the audit. Now, looking at the first 2 papers, which are both correspondence audit based, they have some common features. They both use IRS administrative data on audits of the self-employed. They both look at the post-audit response in 1 or more subsequent years, and they're both trying to address a resource question for the IRS: what types of audits are the most effective? And both have some anomalous findings that for me are difficult to explain without knowing the unknown, which is how does the IRS make its decisions as to who to audit? So let's start with the standout anomalous finding in Brian's paper. Generally, he finds that audits lead to increases in reported taxes in the following year, with one big exception. The correspondence audits that occur effectively in the year that the return is filed lead to a decrease in reported taxes in later years. Now, he observes this for the group. He also observes this for EITC returns. EITC returns represent about half of correspondence returns in general. They are also the bulk of these early findings, these early audits. Now, as such, this finding seems at odds with studies by Debacker and his co-authors and by John Guyton and his. Those studies show that after an audit, there's a reduction in the EITC claims in the subsequent years. Now, Brian suggests the anomaly may reflect differences in the type of issues of the taxpayers that address over the correspondence audit cycle, but beyond looking at the EITC distinction, he doesn't get much further. Now, even though I don't know what is really going on in terms of the audit selection, I do know something about how EITC audits differ from other types of audits. EITC audits are typically based on rules derived from the dependent database. And for those of you who don't know what that is, it's a database that compiles information from administrative data within the IRS with data that comes in from other agencies, and that in combination gives you a sense of who is complying with the dependency rules for child-based tax credits. So they're typically based on those as opposed to what's often used for other types of audit selection, which is the DIF score, which is a math algorithm. Most EITC correspondence are conducted or begin during the processing season. They're identified at that point and before the refunds are paid, hence they are primarily the early audits. And 3, there's a step after the audit before the next filing season, which we can call recertification. That's a step where if you had your EITC reduced in an audit, reduced or denied, and next time you get an EITC, and now it applies to other child-based provisions, you have to fill out an additional form that asks you questions targeted really at the kinds of issues that might have caused problems for the audit. Now, in addition, there's a different incentive in place with respect to the EITC and the refundable portion of the child tax credit, where in fact at a certain low points in your income, there's a incentive to overstate your income to get a larger credit. Once you take away the credit, then that incentive becomes the more typical incentive to underreport your income. Now, knowing those differences, where does that lead me? I think it begins with the choice of how you choose the control group, the unaudited. Now, for the unaudited and the audited to be compared, they need to face similar predicted probabilities of selection for audit. My understanding from Brian's paper is that he's using the DIF score as a measure of that propensity. But my understanding of the IRS is that the EITC returns and other child-related audits, particularly at this pre-refund stage, are largely going to be selected due to issues that arise from comparisons to the child-dependent taxpayer, child-dependent database. So this could cause issues in terms of the methodology if your control group isn't really selected on the same basis as your audited group. I would, in my analysis, I would have taken the EITC out and maybe the other child stuff and just focus on this unique group of people who have self-employed income, who face a marginal decision with respect to how much income or how many deductions they can be claimed. I am mystified too as to when you would do a field return, a field audit for that group versus a correspondence audit. Lee's gets us partly there because within the correspondence audit, she and her co-authors are looking at the particular issues that drive the choice of selection for a correspondence audit. There's still, however, that black box. We don't know how or why a return is selected to audit when another return isn't, even though it has sort of the same risk issues involved. Lee recognizes that prior studies have usually used a DIF score to pick that control group, and that she recognizes in her co-authors that correspondence audits are not strictly based on a DIF score, and they take care of that. But how they take care of that is not known to us, the reader who doesn't work on IRS enforcement, and that's the way it should. I mean, we should know how this is all done, but it does make it harder to understand her anomalous finding, which is that for certain categories, one dealing with deductions and another dealing with the self-employment tax, her starting point, the baseline, shows that the reported taxes by the unaudited are higher than the reported taxes by the audited. Now, I understand that it may be, as she says, the slope that matters after that, not the, at least in her analysis, not where we begin. But I wonder, and this also gets to the selection issue, if the beginning point is representative of some of these mysterious selection factors where we see two returns that look similar in terms of their why you would select them for the audit, but one isn't and what is, and whether then those characteristics end up affecting the slope as well. There are common concerns to both studies. I understand in Lee's study there are reasons for not doing the no change rate, but I do think it's important to not only know if the person was audited or not, but what the result of that audit was. Lee does include the dollar amount as well as percent change. We don't see that in Brian's, and I think that's an important consideration in terms of what you're doing in terms of your audit selection. I don't know if they're looking at the recommended amount or what is the final amount the taxpayer owes the IRS. I would choose the latter if they are not doing the other. And the last two important points is I do think it's important to take into account the IRS's costs. We do know that correspondence audits are maybe on the order of, maybe field audits are maybe on the order of 10 times the cost of a correspondence audit. That does affect the choice. Now, I was there, not in the room where it happened, but in the next room where I did the numbers. I was there when there was an active decision to make, for EITC returns, make them correspondence audits rather than field audits. And in doing so, the deciding factor, in addition to the cost of the IRS, was the compliance burden on taxpayers. What Brian refers to as impersonal, I refer to as a reduction in the burden to the person being examined. And our concern in going in that direction was that lower income taxpayers would find a field audit to be particularly onerous, taking time off from work to be interviewed by the auditor, not having the resources to hire a preparer, an accountant or a lawyer. Those were all considerations, which actually, if you didn't, would have backfired in the IRS and so forth. And the other point is that this was done in terms of working on a deal with Congress in order to get a refundable portion of the child tax credit and also to avoid huge cuts in the EITC. And so those are the kinds of trade-offs that went into a decision to do a compliance versus field, which are not necessarily considered when you're just looking at the dollars. In terms of Matia's paper, I thought to be upfront, I'm biased. And my bias is I don't get experimental economics. Some people like games, I don't. So you see where I'm going. I'm one of those people who don't like games. And I know for sure that if I somehow got drawn into an experiment, I would not act as I truly act in real life. The person I am has obsessed over her tax return for 6 weeks within the bounds of legality over how I could best save less than $100. I'm sure that's I hope that's far less than my hourly wage. If I were in a game, after 2 rounds, if even 2 rounds, I would get bored, I would lose patience, I would lose concentration, I would act in a haphazard manner. They would give you perhaps a totally different impression of what I would do in the tax system. So now that I've revealed who I am, that leads to my question of who are these people who choose to participate in experiments? And more than one time, 95% of the sample said they had been in an experiment before, although generally not in a tax compliance. Do they like games? And does that have some meaning in terms of their liking of risk? And then the other aspect is that people are not born the moment they enter an experiment. And to gauge that, Matthias and Jim asked questions like, did you prepare your own taxes in the past? What is your nationality? German, you're Austrian, something else. They also asked if they like to gamble, their views on tax cheating. Maybe people say the right thing. Maybe they know themselves. But I want to know about their experiences with tax authorities, because I think that's relevant going into this game. Have they or anyone else they've loved been audited, or more generally caught breaking the law? And especially these days, we know that affects behavior. Okay, so all that said, I actually love the paper. I love the framework of the analysis in terms of thinking about honest, compliant, and non-compliant taxpayers. I'd like to go and then looking at the efficiency and probability of an audit. I like all of this. I would go further. I would give them more opportunities for non-compliance rather than just how much income they report. I'd vary the penalties. I'd lie to them about the probabilities of audit and detection. I actually want to know more about the differences between honest taxpayers and compliant taxpayers and what the overlap is. So despite my prejudices, I think this is a very important study, and I don't really know offhand how you would conduct one like this outside of an experiment, with one exception, and that gets to this efficiency of the audit, which I would have both would have been more accounted for in Brian and Lee's paper. So I give the majority of my time back to the Q&A period. Rob, it's your turn.
Thank you, Janet. We're going to have the Q&A period now. I'd like to remind our attendees that they can ask questions through the Q&A box at the bottom, and also follow along on Twitter at #LiveAtUrban. But first, I'd like to ask if our presenters would like to respond to any of Janet's comments. Brian, would you like to respond?
Sure. So thank you, Janet. I'm shocked you talked about the earned income credit. Never expected that.
It is, but most of those audits are.
Yeah. So with regard to the control group, yes, we included the DIF score as one of the predictors. We actually included a wide range of taxpayer return characteristics and taxpayer characteristics besides that to model the likelihood of the different kinds of audits. That being said, you know, there's always a concern that maybe we didn't capture some of the things that might be influencing who gets audited. You know, one can't be sure. We did do things like look at the trends before the audit year to make sure that the groups looked similar prior to the audit in terms of their reporting characteristics, and that gave us some confidence we were doing okay. With regard to impersonal versus burden, well, it's both, right? You know, the good part about you know, a correspondence audit is it costs less to the IRS, and in some ways it's less burdensome to the taxpayer. On the other hand, I'm going to guess that when they made that change and started doing EITC audits by correspondence, a lot more people were no-shows. They didn't respond at all. And that's not necessarily a good thing. But you know, the point for my paper is simply that the experience is a different one, and it may have a different impact on your future behavior.
We don't really, in response to that, Brian, we really don't know because there really weren't that many audits of EITC claimants before this choice was made in order basically to keep the spending at the same level. And we don't know, as a result, how this group of people would have responded to field audits. They may have been no-shows too. They may have not opened the correspondence. They may have not been able to take time off from work. They may just have not wanted to deal with it and just pay the money up front anyway, or just let it be what it was. So it's a counterfactual for this group that we don't know what their behavior would have been like.
Yes, I agree that for that particular group, we don't know for sure. What we do know is that no-show rates are relatively low in general for face-to-face audits and quite high in the case of correspondence audits, and that's some concern. The other thing I'll point out is that, you know, one of the key things about our modeling is that we model both the probability of a face-to-face and a correspondence audit. And that's important because people with a given set of characteristics might be subject to a likelihood of either type of audit, that they're not exclusive in terms of the groups that are targeted by these two types of audits. And as a result, it's really kind of important to control for this whole vector of likelihoods of audit rather than just focus on one specific type. I'll leave it there and let the other participants get their comments in.
Okay, great. Thank you, Brian. Lee, do you have any comments or replies you'd like to make?
Yes, thank you, Janet, for your comments. And I think you touched upon a really important point and challenge to our study, which is that selection is still to some degree a black box. And we see some returns with very high priority that aren't audited, and some returns with low priority that are audited. And while we have learned some of the reasons for why that might happen, the issue arises when those variables aren't necessarily recorded in our data, and then becomes quite a challenge to be able to truly estimate that counterfactual in an unbiased manner. And so that's something that we hope we can improve upon in our research going forward, and I think was a great point.
Thank you, Lee. Matthias?
Yeah, thanks very much, Janet. Fair enough. So obviously, we are well aware of the shortcomings regarding external validity of lab experiments. However, we think this particular design makes sense and adds to what one can do analyzing field data. And again, the main argument being that it's very hard to get an idea of how efficient an audit actually is, what share of non-compliance it actually detects, and to analyze consequently how this factor impacts on subsequent compliance. So we hope that we'll be able to make some contribution based on that. However, I understand everything you mentioned makes a lot of sense, and obviously it's quite a gap between what happens in front of such a computer with relatively little at stake as compared to the actual filing decision. Now, very quickly on some of the specifics you mentioned, I agree that one could have introduced more variation, for instance, in the fine rates. There is ample evidence on that, so we did not really focus on that. I think you rightly point out that it probably makes a difference whether or not participants had been audited in the past. I think the risk, given that there were mostly students on average in their mid-20s, the probability is very low that any of those had experienced an audit. So I think we would assume that they are fresh in terms of prior experiences. And I think it makes sense, and we'll elaborate on the comparison between compliant and honest. So we'll provide more perspective on that. As much as we sometimes would like to lie to our participants, this is unfortunately in general not possible. So I think one common ground would be to introduce more uncertainty about those factors, so we do not need to lie to them up front, but we could just say the range of audit probability is somewhere between, I don't know, 10 and 30%, and this might change the dynamic of our result a little bit. However, it's not entirely clear to me how one would assume that this would result in different responses. So I think the main effect we're trying to isolate here is how people respond to an audit that ends up being less bad than expected. And I think our design allows fairly clean identification of that effect. Whether or not one believes people behave similarly in the real world is obviously a different issue. But many thanks again for your comments.
Thank you, Matthias. So we have some questions from our attendees. First, an overall question for all of the presenters. Does anyone have any thoughts on how tax law changes that now mean most people claim the standard deduction have an impact on compliance in the tax gap? Anyone want to take that on?
Very quick perspective, behavioral perspective on this. I think there's strong evidence that people are strongly biased towards the status quo. So people are more likely to go with the default option than to actively make changes to that default. So in that respect, introducing variation or changes to the standard deduction will probably induce a very strong behavioral response, because most taxpayers, given the literature, would stick to that default option. And it's not that clear to me that from that change, one would assume some behavioral dynamics in terms of people are more or less likely to claim additional deductions, for instance, in that case. On the tax gap, I'll let maybe Brian weigh in for a more qualified assessment.
Well, so, there's certainly significant non-compliance issues with some itemized deductions, such as charitable contributions, where people tend to over-report how much they've contributed. So if people are moved into a category where they're unable to do that, although this year might be an exception to some degree, one would expect that the direct response would be less non-compliance, right? Because some groups are now losing an opportunity to non-comply. On the other hand, there's some evidence of substitution behavior, so that people, expand non-compliance on other line items that they continue to report. But overall, one would think that the effect probably would be reduced non-compliance, I think.
Thank you. Here's a quick technical question for Lee. Is the audit technology assumed to be constant across the years of your study?
So that's a great point and a limitation that I think I touched upon briefly, which is that we don't necessarily have access to the filters and priority back from 2006, but what we can do is look at our audited population and the line items that we know are considered for this type of audit. And just by looking at those distributions in the baseline tax year, we were actually able to infer some places where it looked like the cutoff was a certain, dollar amount and be able to incorporate that into our control group construction. And one other point is that I think in general, while there might be tweaks to the filters and priority, drastic changes would likely result in an entire new category, new name for an audit. And so I think we'd expect the effects of changing technology to be rather minimal. But thank you for the question.
Thank you. Here's another question, I think, for everyone. Would compliance likely be improved by an IRS announcement that audits are more likely to take place for returns prepared by preparers with high error rate?
I'm not aware of any prior work on that particular issue, but there is prior work, and I briefly made reference to that in my talk, in which researchers in cooperation with the IRS send out letters threatening close inspections. So they, I think, did not base their sample selection on the considerations you raise here, so on the type of preparer, but they just say basically, we're going to closely examine your return. They did not threat an actual audit because they, again, did not want to deceive study participants, and they could not follow up on that, but they just said, you're on the radar and we're looking into you. And this study found mostly, there were some dynamics in there as well, but mostly that increasing the threat of enforcement has a positive effect on compliance. And I would assume if one can further specify this message and target it down to individuals with a relatively high propensity of non-compliance, I would assume that the compliance implications would be positive and maybe even stronger than in prior work.
Thank you. So we're out of time. However, I wanted to read one comment. It's not really a question in general. And this is a person who says, I have concerns about the use of the word cheating as applied to all taxpayers who have errors in the returns and are audited. It's possible a taxpayer really wants to comply, but there's a complexity, because of the complexity of the tax issue, they get something wrong. So there's a recommendation that studies going forward refrain from classifying all non-compliance as cheating and explore the role of complexity in tax compliance. So that's not a real question, that's just a comment. I want to thank all of our participants for being here today. It's been an excellent session. Thank you so much. And I'm going to turn it now over to Brett Collins to moderate the second session.